Welcome to Wall Street Week, the show of record for long-term investing. I'm Gary Kamensky.
And I am Trish Regan. Here we are, just 1 week until Donald Trump takes the oath of office. Now, since Election Day, Donald Trump has met with over 50 business executives at Trump Tower, titans from here and abroad, including this week Alibaba's Jack Ma.
We mainly talk about small business and young people and American agricultural products to China. And we also think that China-U.S. relationship should be strengthened, should be more friendly and do better.
So could this relationship between Trump and Jack Ma have an impact on the larger business dealings between the U.S. and China? Our
guests this week are Morgan Creek Capital Management CEO Mark Yusko and the Chief Investment Officer of the Bahnsen Group of High Tower Advisors, David Bahnsen. Good to see both you guys. So what do you think of this move here for Jack to be in there meeting with Donald Trump? What's your sense of things?
Look, I think Alibaba has big plans for the U.S., and I think it's a good opportunity for him to start at the top and begin that relationship that he's been eyeing for a while.
He needs a good relationship with the next president of the United States, and that's part of perhaps what's going into the meeting, David?
Absolutely. I think it also has a lot to do with sending a signal to China. I think that Alibaba and Jack Ma's relationship with China is every bit as affected by the dynamic with Trump as well, and I think it was a really interesting strategic move.
Well, what is the signal they're trying to send?
I think accommodation, relationship, working together, that there isn't going to be this sort of adversarial piece, particularly given Trump's relationship with a lot of the traditional Silicon Valley. It just sort of showed an indication that he was looking to kind of be in a different footing.
Yeah. So, Mark, do you think, I mean, the president-elect has talked a lot about China taking advantage of the United States, that this election was in many parts about getting back at China. Are you optimistic that China, as it affects the investment world, that we're on a better course right now than we would have been?
Look, I think a lot of this has to do with, where was the rhetoric during the campaign versus what's going to be the reality when we get to
what's going to be the reality?
Well, look, my personal opinion is the reality is going to be less extreme than the rhetoric. Look, China and the U.S. have to be friends in terms of trade. They have to be in terms of cooperation, in terms of business dealings like with Jack Ma and Alibaba. So I think that both parties need each other, and clearly we all want a good deal, so to speak. And so there'd be negotiations, and it's a good negotiating tactic to start extreme and come back to us.
Okay, but let's talk in terms of the investment world, in terms of the valuations we see on a lot of U.S. companies and assets. One of the reasons, and there are numerous reasons for why we're seeing upside overall in the market, but even over the last 8 years during President Obama, China emerged increasingly as a buyer of U.S. assets, was willing to put money into the U.S. One would think that, in other words, if it doesn't work both ways, if U.S. companies are not as easily able to buy Chinese companies because the Chinese say, no, we have to have primarily Chinese ownership, then some of that M&A, mergers and acquisitions activity, could start to soften. And does that affect the premium that you see on U.S. companies, David?
I think it has a much bigger impact in real estate even than actual operating entities, but I think that there's a much bigger piece underlying the story, and that is that the mutual benefits that are at play here, there isn't a real clear leverage from either side. They both need each other. I very much wish that I could be at a place to say I think it's mostly bark and not bite. Trump's selection of some of the trade personnel that he's picked, particularly Pete Navarro out in my neck of the woods, Southern California.
He's tough on China.
Oh, that's not bark. They really believe that. That's a deeply ideologically rooted belief system about China. I think that would be catastrophic for markets.
I think we have to.
I agree with that.
It's sort of bottom line with China. It's important to remember that if the infrastructure programs that have been talked about are put into place, they're going to be financed with debt. And Mark, as you pointed out, we're going to need China to buy a lot of that debt. And so the relationship, as you said, it could be a somewhat non-harmonious relationship, but both countries need each other.
You think about how they need each other just in terms of, you don't want to you don't want to tick off your banker, right? But at the same time, your banker needs to get paid.
Absolutely.
And so they need us to succeed if they want to get their payments.
Moving away from China in terms of the rest of the world, the emerging markets, do you find the emerging markets an attractive investment opportunity right now?
We do. We are very excited about emerging markets, have been really since the beginning of last year when the commodity cycle started to turn. And it's not just about commodities, because you've got commodity producers, you've got commodity users. India and China actually benefit from falling oil prices, not rising oil prices, whereas Russia and Brazil want rising oil prices. So we love emerging markets for demographics, great demographics, young populations, growing working age populations. That's where you're going to create wealth and dynamism in consumer activities. So we like that. We really like the valuations. They're cheap. You look how cheap Chinese equities are. You look how cheap Russian equities are, even after the big run last year.
So you're talking about traditional BRIC countries, Brazil, Russia, India, and China.
Yeah, but you can go beyond that into, we're very excited about places like Argentina. What's going on there, both politically and economically, is astounding. You look at what's happening
with the liquidity, though. I got to ask you. I mean, especially in a place like Argentina.
It's so much better than it used to be. For example, they finally came back to the bond market after the default in 2001. They were 15 times oversubscribed. It was the most oversubscribed bond deal last year. So it's changing. But you're right, Trish. It has been tough up to this point.
And David, your take on emerging market investing?
I might have a lot of similar conclusions, but for maybe some different reasons. I would not approach those emerging markets from a top-down standpoint. I think that it has to be investable on a bottoms-up basis. That because of that reason of valuations, there are so many companies with incredible return on invested capital, very high operating earnings growth, and low multiples.
And bottom-up means what?
That finding managers and finding companies that are trading at those levels, not necessarily being somewhat agnostic about the country location.
So not buying country ETFs in the emerging markets, but buying
we would not buy country ETFs right now.
All right, Mark and David, stay right there. Wall Street Week, we'll be right back.